Okay, so let's take a minute to talk about those timing differences, right? So we said the big difference, what makes such a big difference between cash and accrual basis accounting is the timing difference. And we've got to realize one really important thing to realize here is that at the end of the day, okay, revenues and expenses under the accrual basis or under the cash basis of accounting, they're going to be the same amount. They're going to get recorded eventually for the same amount. However, it's those recordings during that period of time that are going to help show the differences. It's going to help make your financial statements, make your journal entries a more accurate representation, a more fair representation of what's actually happening within your operations, right? So the difference between the accrual basis accounting and cash basis accounting is the timing of when the revenues and expenses are recorded, right? We saw that earlier in the last video when we talked about, I think transaction 7 is such a good transaction for you guys to look at to get familiar with these more complex, complicated transactions, especially as we get into adjusting and closing transactions. But transaction 7 really is very good because it shows you that under the cash basis of accounting, the timing was all at once, right? As soon as they handed me that wad of cash, as soon as we handed somebody else that wad of cash, it was gone. It was an expense. It was automatically lumped together an expense in that month on that day. However, if you look at the accrual portion of it, when we actually match those expenses to revenues, when we say, okay, these aren't really an expense until we use these resources, you can see that the expense was much smaller. It was only $250,000. And that just goes to show you the difference in timing between the two and when we record them, okay? So like transaction 9 for the payment of salaries, we can see that occasionally, regardless of which basis of accounting you're using, the timing is going to be the same. So, December 28th, we paid $28,000 in cash for our employees' salaries. Well, for cash and accrual, it was the same timing, right? It was the end of the month, so for accrual accounting, we were able to say we have used resources. We've used some of these resources up to help us generate revenue. So we're gonna record that expense, that $28,000 expense, and at the same time, we said, we spent $28,000 in cash. We've got to record that transaction, and that was the cash transaction recording, right? So public companies, as we mentioned, they must use the accrual basis of accounting when reporting to the SEC. Cash accounting is not considered GAAP. I would imagine I will ask you a question about this on the exam. Is cash accounting GAAP? It is not. Please remember that, okay? This is very important. Cash accounting is not considered GAAP. Small businesses that end up having to report their financial statements for whatever reason, typically it's for tax accounting purposes. They end up paying a lot of money to accountants to come in and convert their cash accounting systems into an accrual basis of accounting. Okay, so those of you that are entrepreneurship majors, those of you that are management majors, those of you that are wanting to start your own small business, at some point in the future, if your business gets large enough, your transactions are going to be complicated enough and you're going to have enough funds, you're going to have enough revenues, enough expenses that at some point, in order to really limit your tax liability, you're going to have somebody come in, probably an accountant, probably a CPA, and it's going to cost you thousands of dollars to convert from the cash to accrual. So if you can learn this now as a small business owner and learn to implement it now, you'll save yourself a bunch of money in the future. So what we really want to talk about in Chapter 4, this is the meat and potatoes, so to speak, of Chapter 4, okay? And this is why I told you guys I think it's so important that you understand Chapter 3 first before we really move on to Chapter 4, because if you were struggling with the concepts in Chapter 3, what we call those original journal entries, these are going to be a little more difficult. Okay, these are going to take some more conceptualization and really understanding why we're making this journal entry. Why are we increasing or decreasing this account? Okay, but these are all adjustments that we make at the end of the period, because think about it. And we'll go through these examples, but what did we do? Well, we had prepaid rent. So we've got 12 months of prepaid rent in the amount of $180,000. Well, what happens at the end of December when we actually use $15,000 of that? Well, we got to record it. We've got to show that somehow, right? And that's what these adjustments are for. So In accrual accounting, when we're doing this type of accounting, we create timing differences between the inflow of cash and the revenues and the outflow of cash and the expenses that they're related to, right? We talked about that. That is the difference between cash and accrual basis accounting. So when we get these timing differences, we report them as either assets and or liabilities. It just depends on what they are, right? So if it's prepaid rent, if it's a resource we're going to get to use to help us generate revenue, that's going to be an asset. If it is like an accounts payable, we're not going to be paying cash for another month or so. That's a liability. If it is cash that we got in for a service service that we're going to provide in the future, again, that's a liability. That's something we are liable to provide. Okay, so assets are the inflows, liabilities are the outflows, typically speaking. Okay. We make adjustments to update the balances of the assets and liabilities. Okay, so that's what these adjustments are really for. Again, I cannot express to you how important I think it is to go back and review Transaction 7, both in terms of Chapter 3 and what we'll look at in Chapter 4 as well. Okay, I think it's a pretty good comprehensive journal entry that really explains the whole cycle. Okay. We have to make these adjustments. These adjustments are necessary. Okay. We have to make adjustments so that we can account for everything that actually happened during the period. Okay. So let's take a look real quickly here. This is going to be our prepaid expense and deferred revenue. Okay. What we're talking about really here is in advance. Okay. If we pay cash in advance, we've created an asset, right? This is a new resource for us to use. Okay. If we pay in advance, that's called a prepaid expense, and this is an asset. This is an increase to assets, okay? If we receive cash in advance, this is an increase to liabilities, right? If we receive cash, now we've created an obligation to provide a good or service. Okay? Those are liabilities, right? We know that liabilities are obligations that we have. Here's the timing difference, okay? So once we've paid cash, we've created that prepaid expense. As we use the cost of that, as the asset expires, so to speak, and you can't see me, but I put up my fingers there, right there like that, okay? As that asset expires, we're going to decrease the remaining amount of that asset, and we're going to recognize an expense. Okay, so that's like if you bought, and this is what happens at my house. Let's say I go to Walmart and I buy myself a package of Oreo cookies, right? That is now my asset. I have prepaid for delicious Oreo cookies to be shoved into my mouth at my leisure. However, throughout the month, my son also decides he wants to shove some Oreo cookies in his mouth. So as those Oreo cookies disappear from that tray, that is my asset expiring. That is my asset being used up, and I would recognize that. Okay, I used some of these Oreos to make my gut fatter and make me smile more. I used that resource up. That was an expense. We'll call it my Oreo expense. Okay. Did I spend any cash on those Oreos that month? No, that cash was spent when I gave the cash over at Walmart, right? When I paid Walmart for those Oreos. So that cash isn't part of the expense. Just the Oreos that I've eaten out of that tray and that my son have eaten out of that tray, that is the expense, okay? So as you're using the asset up, we're going to decrease the amount of that asset and we're going to recognize an expense with it, okay? So it's kind of the same thing with liabilities. It's just kind of opposite, right? So as we provide that service, as we provide that good, we meet our obligation, then we can decrease the liability to the remaining amount. We're going to recognize revenue. So this one is, you pay me $1,000 to paint your house. I have not painted it yet. But in the month of November, I do $500 worth of work. Okay, so I would reduce my liability by $500 because I've provided you $500 worth of work. I've met $500 worth of my obligation. And I would increase my revenue by $500 because since I have finally met my obligation, since I have finally performed that obligation, I can recognize that revenue. So if you have any questions about adjustments at the end of the period for prepaid expenses and deferred revenues, do not hesitate to contact me. These can be some of the more confusing concepts that we talk about in this class, so I really want to make sure you guys are clear on these.